Welcome back. It was reported new home sales plunged in November. This is a story from late last week. We wanted to mention it because it's actually a pretty significant piece of news. And we're going to see here in just a moment, not only did the annual rate of new home sales dropping to 590,000, we're also going to see an issue with mortgage spreads. New home sales in the U.S. dropped in November as mortgage rates slowly retreated from the highest levels this year. This is reported on CNN.com. We can see here, this is in thousands of units, 590. It's the lowest low we've seen all year, going back to November of last year. Certainly, I think this was a pretty big surprise to the housing market. Now, month over month, we see on the left hand side, this is the ratio on a month over month basis, new houses for sale versus new houses sold. This bar is going up. It means there's more houses for sale than houses sold. And this is the change. It's up 16% on a month over month basis. Well, what does that mean? It actually comes from the fact that the new one family houses sold is down so much, down 12%. The new one family homes for sale on the right hand side, that's inventory. That didn't move so much. It's all a result of the new one family homes sold. The velocity of sales has plunged quite a bit, and that's what sent this ratio up so much on a monthly basis. Year over year, we didn't see that much of a move. Now, we can see here green bars, federal funds rate going back a couple years, new one family homes for sale. This is the inventory. We certainly had very high inventory coming out of the COVID crisis that plunged quite a bit as a result, in part, of rising interest rates. It's moved back to the upside slightly, perhaps as a result of the anticipation of lower rates, but certainly this is not going back to the levels that we saw in 2021. Now, we can see here again green bars, federal funds rate, red line, new one family homes sold. And this is the big news. We're plunging back down to levels we have not seen all year. In fact, going back to November of last year, low interest rate environment certainly did help the new one family houses sold number. And perhaps a lot of potential home sellers ran to the market in anticipation of higher interest rates. Well, interest rates certainly did go up. Maybe there's a little bit of a delayed effect, and there's the reporting mechanism as well that caused a little bit of a delay in this line. But nevertheless, the velocity of homes being sold is going down quite a bit, which is actually kind of troubling because we would think, hey, mortgage rates are starting to creep lower. Well, it's almost a certainty we're going to have lower interest rates in the future. Why is this line going down so much? Now, green line, new one family homes sold. Red line, new one family homes for sale. So the inventory on the top is starting to go back up. And then the homes sold, the velocity of sales is going down quite a bit. Real estate brokers are not closing a lot of business these days. And this is not only as a result of higher interest rates, there's also a fairly tepid jobs market we've been reading about, a very tepid manufacturing market also that we've been reading about. So certainly there's not a tremendous amount of stability in the economy, and I think that's maybe why, there's not a lot of buyers out there buying up these homes. With that said, there's also an issue of mortgage spreads. What's a mortgage spread? It's the difference between the 30-year mortgage and the 10-year U.S. Treasury bond. Now, typically, 30-year mortgage, we would think of the 30-year Treasury bond, plus a little bit of premium because it is a mortgage. But there's a spread, and this does vary from time to time. What's the significance? A mortgage spread typically widens before and during recessions. You see, what happens is when a potential home buyer walks into a bank and says, I want a mortgage, the bank is going to look at the economy and they're going to say, well, the economic condition really doesn't look so great. We're going to charge a couple extra points on our mortgage as insurance to us because the economy doesn't look that good. Maybe this individual won't be able to pay back their loan. So as a result, that spread widens. When we see a widening spread, it's a sign that we're before or leading up to or in the middle of a recession. Well, what we can see over here, green bars show us the mortgage spread. Again, this represents the difference between the average 30-year mortgage that we all see advertised and the 10-year U.S. Treasury. Well, 10-year US Treasuries have been coming down since October, quite a bit actually. The mortgage spreads, not really so much. We're still at very significant highs. In fact, we're at higher level than we were in October of this past year. And certainly, I think there was more fear at that point that maybe we were going to see higher interest rates at least. So the point being is that the new one family home sold, the velocity of sales is going down quite a bit, and mortgage spreads are still factoring in a certain degree of risk within the market. So, while we see maybe on the headlines there's good news, there's still trouble out there, and we should be aware of it. As a reminder as well, please see our new Twitter daily technical trading journal, where every single day we recap the major stock indices, commodities, treasury bonds, cryptocurrencies, etc. We're looking for significant moves. And we post this on a daily basis on our Twitter account. It's at Just the Data as well. So please visit us there, and we'll be sure to update you along the way with any significant changes, technical or fundamental. We hope this has been helpful. We look forward to seeing you back soon.